You've probably heard terms like index funds, mutual funds, hedge funds, and ETFs.
In this video, I'm going to break all of these down in the simplest way possible: what they are, how they work, the risks, fees, strategies, and who they're best for. Give me just 4 minutes and you'll understand what takes most people years. And of course, this is not financial advice. What is a fund? Explained super simple. Imagine you and your friends are planning a big party. Instead of one person paying for everything, everyone puts in a little money. Now you can buy food, drinks, decorations, and enjoy the whole event without one person handling all the stress. That's basically what a fund is. A lot of people pool their money together, and that combined money is invested in things like stocks, bonds, or real estate. You don't manage each investment yourself. The fund does it, and you share the results. Index funds, the social media favorite. Index funds get tons of hype online, and for good reason. An index fund doesn't try to pick winning stocks. It just copies a list of companies called an index. The Nasdaq tracks big tech firms like Apple, Microsoft, and Amazon. The Dow Jones tracks 30 large U.S. companies across different industries. No guessing, no stock picking. The fund simply mirrors the index. Index funds are passively managed, so the fees are extremely low, often between 0.02% and 0.20%. This is why they're considered low risk and beginner-friendly. Important: index funds are priced once per day after market close, the NAV. If you buy at noon, you still get the price set at 4 p.m. Mutual funds, same idea, different strategy. Mutual funds look a lot like index funds, but they're usually actively managed. That means a professional manager is constantly buying and selling investments, trying to beat the market. Because of that, the fees are much higher, often 0.5% to 1.5% or more. And studies show most mutual funds don't outperform the market long term. Still, people choose them when they want. A specific investing strategy. Access to certain countries or sectors. Hands-on management. Like index funds, mutual funds also trade only at the end of the day. Hedge funds. High risk, high reward. Hedge funds are a completely different world. They're private investment funds for the wealthy, usually only open to high net worth or accredited investors. They use aggressive strategies like short selling, leverage, borrowing money to invest more, derivatives, complex trading algorithms. They're known for the famous 2 and 20 fee structure. They can make huge returns, but they can also lose a lot. They are not designed for everyday investors. ETFs, the best of both worlds. ETFs, exchange-traded funds, work like a mix between a stock and a fund. Like index funds, they offer diversification and usually follow an index. But unlike index funds, ETFs trade all day long, just like a normal stock. You can see the price change in real time, buy whenever you want, and sell whenever you want. You can invest in almost anything through ETFs. Tech, gold, bonds, real estate, international markets. They're flexible, cheap, and easy to use. Final thoughts. Which one is for you? Index funds and ETFs. Best for most people. Low cost, low effort, great for long-term investing. Mutual funds. Good if you really believe in a manager's strategy, but watch the fees. Hedge funds. Only for wealthy investors willing to take high risks for high potential returns. If this video helped you understand funds clearly, hit the like button and subscribe.